Can I quote a smart guy to you, Drew? Good morning, by the way. Okay, this guy wrote this. He said, recent robust U.S. growth and relatively stable U.S. financial markets provide space for U.S. policymakers to, quote, take some pain as they pressure China for concessions. That smart guy is you. You recently wrote this. Jamie Dimon, you may have heard, says, we're going to be okay. Obviously, I think you would agree with the J.P. Morgan CEO.
Sure. I think when you look at it, I mean, skirmish is fine. I'd call it a spat.
Tussle.
Yeah, I mean...
Two kids pushing each other in the playground.
But at the end, we have to get along. So, yeah, spat, it's going to get resolved. It's just a matter of how long it takes. Our view is that this could go on for quite some time, but that the net result's probably not going to get, too bad.
Yeah, so the great Leslie Picker and I were discussing earlier what would move this from... What would cause Jamie Dimon to change it from, okay, it's not a trade war to it is? Is it merely the longevity of this? Is it the severity of it? Is it upping it from 10 to 25% on the tariffs? What would change that to sort of ratchet it up to the next level?
I think the main thing would be that if there was a mistake made. So someone pushed a little too hard. We started to get some weaker economic numbers in the U.S., and instead of that causing a response that made everyone a little more agreeable, it actually caused people to harden their positions and dig in. So it really is the response to any sort of signs that it's beginning to have an effect.
Okay. I want to play this as well. Jamie Dimon was in a very bullish mood, by the way. He gave these comments to CNBC International in India overnight. Drew, listen to Jamie Dimon's comments about emerging markets, and I want you to respond to that as well.
I'm not really concerned. You have, first of all, put Turkey and Argentina aside, where I think you have very serious issues. The rest of the emerging markets are actually doing quite well. And, America's gotten stronger. The dollar's gotten stronger, but that's actually good for the world. The world is actually growing quite healthily. And so the emerging markets, it's just more like a teething pain. And you're absolutely right, they're not all the same. I don't even think they should be called emerging markets anymore, to tell the truth.
So in a kind of like the trade issue, saying, yeah, there's a couple pockets here to worry about, but overall, we are going to be okay.
Well, I think that's right. It hasn't spread. When you look at the countries that are actually experiencing the most stress, they have something else going on with them. It's not purely just an economic story in the most cases. There's a political dynamic to it all as well. There are areas of opportunity in emerging markets. It's just a question of how much risk you want to take for the return. Right now, I think, although we're very optimistic on the economy, you think rates are going to be moving higher as we do. You want to be exposed to kind of variable rates, and you want to be exposed to things that'll give you.
What do you mean by that?
So one of the more interesting things that we've noticed is that cash is looking increasingly attractive. So although we're although we like risk, we like smart risk, and if you look at where cash is versus a lot of other things, 3-month LIBOR is actually pretty attractive on a relative basis.
Okay, I got to apologize to viewers. I failed in my job completely this morning. I'm the worst TV host in America because that should have been our lead. Well, if somebody comes on this show and recommends cash, I'm thinking, put the money in the milk crate in the basement, Jasper, because here come the aliens.
No,
why is cash looking so good?
It's because of the relative yield and the exposure to rising rates.
That there is no yield. I mean, I guess relative to. Does that mean you think everything's going to go down?
No.
Then what yield are you talking
I tend to focus more on fixed income. So there are a lot of good opportunities in equity space. There's a lot of good opportunities still in credit. But if you look at it, cash isn't looking all that bad anymore either, simply because of what's been going on the front end of the yield curve. Front end of the yield curve has been moving up sharply. So when we all talk about the flattening of the yield curve and people begin to worry about that, what they should be focused on is what they can get at the front end of the yield curve now that rates have been moving higher.
Does that yield, and again, the yield curve, by the way, it's early, 2 and 10 years, the difference between the two, we want to keep it sort of jargon-free at 5, whatever clock it is this morning. Does that signify to you a slowdown? Because I've heard people say, yeah, it means a slowdown. Or, no, there's certain technical things going on. China's selling, got some other moves in the bond market. That flattening of the yield curve doesn't necessarily, big word alert, portend bad things.
It's not really a big word.
Well,
it's 7 letters.
Leslie, can you take over this interview, please? It's not going well.
Is 7 letters a big word? I guess that's the question.
Nice quick addition, by the way, on your part. I'm like, P-O-R.
It can. Our view at Metlife is that the Fed and market participants are going to look at an ever-flattening yield curve, a tightening yield curve, the 2s, 10s spread getting narrower and narrower. And at some point, the market's going to say, we don't like where this is heading. This portends a recession, right? So I added an S to it, so I get 8 letters now. So if we were doing Scrabble, I'd be in the lead. When that happens, when the market begins to react negatively to this idea that the Fed's going to keep raising rates, even though the yield curve is getting flatter, that's actually when the Fed will actually say, hey, wait a second, we can't just keep hiking without regard to what the markets are doing. So the Fed never likes to say they're looking at equity markets. They're looking at financial conditions, which you might as well read as the S&P 500.